Good evening, everyone. I know many of you would have been watching your phones all day today, watching the numbers move, watching the news, and perhaps feeling a knot in your stomach. That is, you haven't felt for a while. I understand that, but I also want you to know that I am here precisely for this moment, not to tell you that everything is fine, because the truth is today was a very difficult day into the markets. Yes, a genuinely difficult day, but I am also here to tell you something that is equally true, that what you are feeling right now, that anxiety, that urge to do something and anything, is the single biggest threat to your wealth, not the market. Yes, this is Rajat Dhar. I am managing partner at Finogent Solutions LLP, and this evening I want to have an honest, clear-headed conversation with every single one of you about what is actually happening. Why is it happening? What the smartest institutions are saying about it in the world, and most importantly, what you and I should be thinking about doing. Yes, so put your phones down for next 30 minutes, not away, but down, and let us think together. The first and foremost, the key takeaway is the market fell today. Your wealth did not disappear. A price decline on a screen is not a permanent loss of the wealth, it becomes a permanent loss only if you sell it. The investor who holds the quality through the storm and the investor who panics and sell are standing in the same rain, but one of them is going to catch pneumonia voluntarily. Let me first tell you what actually happened today, because there is a lot of noise out there on the social media, on WhatsApp, on financial news channels, and I want to cut through all of it. The markets fell. The market fall has nothing to do with India's GDP. It has nothing to do with corporate earnings. It has nothing to do with the government's physical management or the RBI's handling of the economy. So those fundamentals are intact as far as those are concerned. Now, what happened today is a story that began on the other side of the world around 10 days back. That is on the 28th of February, the United States and Israel launched a major military operation against Iran. The supreme leader of Iran was killed in an opening strikes. Now, the Iran retaliated, no doubt about it. And in the retaliation, they did something that energy markets had feared for decades. They effectively shut down the shipping through the Strait of Hormuz. Most of you may be wondering, what does a military conflict between America, Israel, and Iran have to do with my mutual funds or my portfolio, and why my capital is getting wiped out into the market? And why, and that too with my retirement corpus. So therefore the answer is one word, which is called as oil. So the Strait of Hormuz is a narrow stretch of the water, barely 40 kilometers wide, and at this narrowest, through which approximately 20% of the world's oil supply pass every single day. Iraq, Saudi Arabia, Kuwait, UAE, their oil travels through this strait to reach the world. And right now, that strait is effectively closed. The tankers are not moving. The insurance companies are not insuring ships that try to go through. And the Gulf countries that export this oil are running out of storage. So they are starting to cut production because they have nowhere to put the barrels. So therefore, the result is the price of crude oil has done something it has not done since Russia invaded Ukraine in 2022. It has crossed $100 a barrel. In fact, at its intraday peak today, it touched nearly $120. Now, this is a price increase of nearly 60% in 9 days. Nothing in the history of oil futures trading has ever moved quite like this. So therefore, this brings us to the second takeaway of it, which is this is an external shock. It is not a domestic structural failure. India's economy did not change overnight. What changed is the global price of a commodity we import. The difference matters enormously, no doubt about it. Now, the external shocks are temporary by nature. Structural failures are not. Structural failures are more permanent. So every previous geopolitical oil shock, whether it is the Gulf War, Iraq, Ukraine, was followed by a market recovery once supply routes were normalized. So therefore, with this we come to the second segment, which talks about the why India is in the crosshairs. Now, I want you to be honest with you. India is not an innocent bystander in the situation. We are not merely caught in the global storm that has nothing to do with us. Now, India is structurally one of the most vulnerable large economies to an oil shock of this nature, and there are three reasons for it, and I want you to understand each one of them. Point number one, we are the world's third largest oil importer. More than 85% percentage of the oil India consumes comes from abroad. The large portion of it comes from the Gulf. So when the Gulf's ability to export is disrupted, the India feels it immediately and disproportionately. So therefore, the second reason being the rupee. When the oil becomes more expensive, India's import bill rises dramatically. The demand for dollars goes up to pay for that oil, and so the rupee weakens against the dollar. because we are buying in USD. So therefore, today the rupee touched its the lowest level against the dollar in history, all-time low. Now, a weakening rupee means that even if the global oil price were to stay flat, the cost of oil in rupee terms keep climbing. It is a compounding problem. So therefore, the third reason being, and this is one that worries me the most, that is the inflation. Now, when the oil price goes up, everything depends on transportation goes up. Vegetables, FMCG projects, manufactured products, the cost of moving everything in this country is tied to a diesel. And when the LPG price rise, which they just did for the second time in under a year, it hits every household kitchen directly. So yes, the challenge for India is real. I am not here to paint a rosy picture. What I am here to do is to help you understand where the challenge ends and what India's strengths are in facing it. So therefore, this brings us to the takeaway third, that is India has buffers, but they are not unlimited. India's foreign exchange reserves, our last refining capacity, the government's fiscal tools, and RBI ability to intervene. These are the real and meaningful defenses that we have with us. But they are not infinite. The duration of this conflict is the single most important variable for India's economy right now. A 4 to 6 week disruption is still manageable. A prolonged, months long closure of Hormuz is a difficult category of a problem. So, therefore, with this, we can now think about coming into a section 3, that is the S word, stagflation, and why it matters. There is a word that is starting to appear in the research notes coming out of Goldman Sachs, Morgan Stanley, Nomura, and other leading global institutions, a word that investors and central bankers deeply fear. And I think this is important that you hear it right from me now, because it becomes the dominant narrative in the media. The word is stagflation. Now, the stagflation is the economic condition where the growth slows and the inflation rises at the same time. So, normally it happens that growth increases because there is more supply of money, and the inflation rises. Now, here is another thing. Now, while the growth is slowing down, the inflation is also rising at the same time. Now, it is the worst of both the worlds for an economy. Normally, when the growth slows, the inflation also falls, and a central bank can cut the interest rate to stimulate the demand. But in a stagflationary environment, the inflation is rising even as the economy weakens. And so, the central bank cannot easily cut rates because that would make the inflation worse. Therefore, it becomes a trap. So, the last major global stagflationary episode was in the 1970s, triggered by an OPEC oil embargo. It took nearly a decade to fully unwind. So, I am not saying we are headed there, but I am saying the risk is real enough that the world's most sophisticated institutions are using the word in their analysis for this moment. And we at Finogent want you to understand that what it means for your portfolio. So here is the practical implication. Now, when the stagflation risk rises, several things that investors normally rely on stop working the way they were expected to do. For example, government bonds, which usually go up when the economy slows down, do not fully protect you, because the inflation fears pushes the interest rates up, which pushes the bond prices down. So, on the other end of the spectrum, in the equity markets, which normally bounce back quickly after the geopolitical shocks, they face a longer headwind because corporate earnings get squeezed from both the sides, that is, the rising input costs and also the slowing consumer demand. So, even some safe havens stop behaving as they expected. So, which brings me something I know many of you are confused right now. That is segment 4. Why is gold not rallying more? The reason being the Haven Cannibalization paradox. Let me ask you something. You are watching a geopolitical crisis. The oil is going through the roof. The markets are crashing. The rupee is at the all-time low, and you open your gold tracking app or your gold bees, and the gold is not going up sharply as it expected to be. In fact, from the recent peak, it has even pulled back a little. Now you are thinking, wait, this is exactly the kind of moment the gold is supposed to shine in. So why it is not? So what is going on actually? So this is one of the most important things that I can share with you today, and it is a counterintuitive. Yes, it is a counterintuitive enough that most retail investors and frankly many financial advisors will not be able to explain it to you. What is happening is that institutional desks are calling Haven cannibalization, and I want you to explain this with an analogy. Now imagine there are two safe rooms during a flood. One is gold, the other is the US dollar. Now, normally, when the world panics, the capital flows into both of these rooms simultaneously because it's a safe room. Now, but in a stagflationary oil shock, which is what we have right now as the case at hand, the US dollar becomes so overwhelmingly attractive that it actually attracts more money, and more capital starts moving away from gold into the US treasuries. Now, here is the reason why it happens. When the oil price surges globally, the world needs more dollars. Now, the oil is priced in dollars. Countries rush to acquire dollars to pay their import bills. Meanwhile, the global investors who are losing money in Asian and European equity markets are selling those assets and moving that capital back to the United States, specifically to the US treasuries and the dollar cash. Now, the result is that the US dollar index, which measures the dollar's strength against a basket of major currencies, surges sharply. And here is a crucial irony. Gold is also priced in dollars. So, when the dollar becomes very strong, gold automatically becomes more expensive for every non dollar investor in the world. So, therefore, a Japanese investor, an Indian investor, or a European investor, they all look at gold and find it has become pricier in its own currency terms. This reduces their demand, and the institutional investors who are running large multi-asset portfolios and are facing losses everywhere, they often sell their gold positions and raise cash and meet what are called as margin calls. Yes, margin calls on their portfolios. Now, so you have two forces pulling in opposite directions on gold simultaneously. The geopolitical fear factor is pushing it up, the dollar strength and institutional selling are capping it and pulling it down. Now, the net result is that the gold reaches a high. It did reach nearly $5,400 this cycle and then consolidates without breaking dramatically higher. Now, the silver behaves similarly and is actually more volatile because it has industrial use, which make it sensitive to the global growth fears as well. Does this mean gold has failed you? Absolutely not. Gold has done its job. It protected the capital in rupee terms significantly better than the equities have done in this period. Now, what it actually means is that this very specific environment, an energy driven, dollar denominating geopolitical shock, gold is not the clean, safe haven it is during the normal risk off scenario. In a normal scenario, gold is the best risk off, but not in oil crash scenario. And that is a distinction. It is critically important for how we cushion their portfolios. So now with this, we come to the key takeaway 4, which is called as gold is not broken. It is being competed with by a dollar. Now, in a stagflationary oil shock, the US dollar becomes the primary safe haven, not gold. So the capital is flowing from Asian and European markets into the US Treasury and also the dollar assets. Now the gold remains valuable and will resume its structural uptrend when the dollar weakens. But in the near term, do not be alarmed that the gold has not spiked further. Now it is still outperformed equities in the crisis. So you can still retain your gold allocation. Do not add aggressively at a very high levels. Wait for consolidation to compete. So these are the things what a sane investor would be doing rather. With this, we are coming to the segment 5, which is called as the global capital tidal wave. Let me now explain a larger picture of what is happening to the global capital flows, because this is what is actually driving the weaknesses in our markets and in the markets across Asia. When the fear spikes globally and the fear index on the Indian market, that is VIX, volatility index, surged by more than 20% today, the capital does something very predictable. It runs home. It runs to the safest and the most liquid asset in the world, most universally accepted asset in the world, and that asset is the United States Treasury bond. Not Indian government bonds, not German bonds, not Japanese bond, only US Treasuries. Now think of it in this way. The world has a financial panic button. When the investors across the globe press the panic button, the money flows almost automatically into the two things, the US dollars and the US Treasuries. Now, this is not the new phenomenon. It happened after the September 11th. It happened during the 2008 financial crisis. It happened during COVID. And it is happening right now. Now, the implication for the emerging markets like India is a direct and immediate. The foreign institutional investors, the large global funds that own Indian equities, they sell their Indian stocks. Now, they take those rupees, convert them into the dollars, and move that capital to the perceived safety of the US Treasury bonds. Now, this selling pressure adds to their market decline, adds to the rupee weakness, and creates a negative spiral that feeds itself in the short term. Now, this month alone, the foreign institutional investors have sold close to 22,000 crore rupees worth of Indian equities. Now, that is significant. And the selling is coming not because they have lost faith in the Indian story or the long-term story that India has, but because of the global panic. The first reflex is always to reduce exposure to the perceived risk assets. And emerging markets, by definition, are categorized as the risk assets in the global institutional playbook. But here is what it is you also need to understand, and it is something that perhaps not everyone will tell you. US Treasuries themselves are not a perfect safe haven this time. The yields on these bonds, which move inversely to the prices, have been rising, which means even the US bonds are losing value. The stagflation dynamic I described earlier in this video is affecting even the traditional anchor of the global safety. The German government bonds are seeing the same problem. What this tells us is that we are in the genuinely unusual market environment. So, the old textbook rules that equities fall, bonds rise, gold rises, dollar weakens. They are not all playing out together as they normally would. Now, and that is precisely why you need an advisor or a banker who is reading the research carefully and helping you navigate rather than simply applying yesterday's rules to the today's reality. So therefore, with this, we come to the point number 5, which means FII selling is a reflex action and not a judgment on India. So when the global fear spikes, large institutional investors sell emerging market equities first and ask questions later. This creates a technically overload, or you can say an oversold condition in the markets like India that historically reverses sharply once risk appetite returns. Now, the underlying story of the India's growth, demographics, and the earnings potential has not technically changed. Now, what has changed is the global risk temperature. Those are the two different things we are talking about. So therefore, now if we look at the next segment, we are talking about history as a compass. I want to take a moment, always from the charts, away from the data, away from institutional research notes, and talk to you about the history of moments like this one. Because I have sat in this chair through multiple crises over the course of my career. I was watching markets during the global financial crisis of 2008, a 60% decline in less than a year. I was watching in 2020 March when the COVID hit. It caused the fastest 40% crash in the modern market history. I was watching during the Russia-Ukraine conflict of 2022 when oil spiked and the inflation ran hot globally. And what I can tell you with complete conviction is that in every single one of those moments, the investors who panicked, who sold at the point of maximum fear, who said this time it is different and this time the world is actually ending, they made the worst financial decisions of their life. And the investors who stayed disciplined, who held quality stocks and the holdings, who perhaps even deployed some additional capital that they had with them to do the rupee cost averaging and to lower their risk. And when others were actually fleeing the market, they built the generational wealth. Now, and I also want to be careful here because I never want to give you a false comfort or a false hope. This crisis does have features that distinguish it from the prior episodes. The effective closure of the Strait of Hormuz is genuinely unprecedented in the modern era. The geopolitical complexity of this conflict is higher. The inflation dynamics globally are more challenging than they were in 2020. I am not dismissing those differences, to be very frank. Now, what I am saying is that the human fear response in a financial crisis has never, not once in the history, been a good investment advisor. The fear tells you to sell when you should be protecting. Fear tells you to abandon your plan when staying the course is the most optimal strategy. Fear never built wealth. Discipline, framework, and the clarity of the thinking are the things which actually build wealth. So now, every previous geopolitical crisis felt like a final one, and frankly speaking, none of them were actually. So therefore, the Gulf War of 1990, the dot-com crash or 9/11 or the 2008 financial crisis, COVID-19, Ukraine, in every single instance, the investors who held quality through the cycles recovered and went to the new highs. The Strait of Hormuz will reopen. The Iran and the US will reach some form of accommodation or transition. The oil prices will normalize. The question is not whether this resolves, but whether you are still invested when it does resolve. So therefore, section 7, what you should actually be thinking about your portfolio right now. Now let me speak as a counselor to you, no, not as a commentator. The question is, I know every single one of you has in your minds, what do I do with my portfolio right now? Do I sell? Do I buy more? Do I average out? Or do I just watch? Let me give you an honest and calibrated view to this. Now, the portfolio thinking, that is what we do at Finogent Framework with us. First, do not liquidate quality to raise cash. If you're already holding on some quality bets, don't raise cash by selling them. So if you own fundamentally strong businesses, good banks, quality consumer companies, well-managed firms, pharmaceutical businesses, this is not the time to sell them. You are not reducing risk by selling the quality equities at a 20 or 30% discount from their highs. You are crystallizing a loss. You are converting a volatility into a loss by booking the loss and exiting the market and handing that value to the buyer of on the other side of the trade. Because when you're selling, somebody else is buying. So the smart money or the smart person is on the other side of the table in this case. So markets will price these businesses correctly once the fog of those crises are open. Secondly, ruthlessly review your vulnerable holdings. Now, this is not the same things as selling everything. But there are specific categories of holdings that deserve careful review. The companies with a high direct exposure to oil, like airlines, chemical companies, paint companies, energy intensive manufacturers who do not have the pricing power. But the companies that were already weak on fundamentals before the crisis happened, if you have holdings that are already question marks, this event has accelerated the urgency of that conversation with your banker. So the point number 3, rebalance towards rupee depreciation beneficiaries. Now, here is something that not many are talking about today. The fall in the rupee, painful as it is in many of the contexts, is actually a gift for the certain categories of the Indian companies. The information technology companies, which are really good one, not the one which are impacted by the AI, pharmaceutical exporters, now the select specialty chemical exporters, those companies earn in dollars and report in rupees. Now, the weaker rupee means their earnings in rupee terms are automatically higher. While these stocks have also fallen today, they have fallen less and their fundamental earnings outlook has actually improved. Now, this is relative opportunity that I am talking about. Fourthly, increase your allocation to the short duration debt. Now, in this environment where the RBI is likely to hold the interest rate steady or even face pressure to raise them, long duration bonds carry the interest rate risk. Short duration instruments, liquid funds, short-term FDs, short duration bond funds give you the capital safety, reasonable returns, and an optionality to redeploy when the clarity emerges. Now, if you have been sitting heavily in the long duration debt, expecting the rate cuts, now this is time to reconsider that positioning. Fifthly, for the NRI clients specifically, the rupees at the all-time low is a double-edged sword. On one hand, remitting money to India right now gives you dramatically more rupees per dollar, meaning Indian assets are cheaper for you in dollar terms than they have been in a very long time. At the same time, your NRI fixed deposits, which earn around 5.5 to 6%, which will still provide you a full tax-free return on your money, have become more attractive when you look at the dollar return. Now, the combination of the interest income and a potential rupee appreciation when the crisis normalizes can be very meaningful to you. Now, this is a conversation worth having with your relationship manager. Point number 6, on the gold and precious metals, maintain your existing gold allocation. It has done a very good job. It's doing its job. It has protected the capital related to the equities in the crisis. Do not panic sell gold because it is not going up as fast as you had expected. And do not make aggressive new additions right now at these elevated levels. Wait for consolidation to complete. Watch whether the dollar shows any signs of weakening and then reassess. Now, the gold structural story, if we think central bank accumulation, inflation hedge, dollar weakening over the medium term still remains fully intact. So now this brings us to the key takeaway 7, that is, in a crisis, portfolio decisions should be made on a framework and not how you feel. The instinct to do something is almost always wrong in an immediate aftermath of a crisis. The right action is almost always do the right thing. Review, rebalance at the margins, protect quality, and look for the opportunities that genuine dislocations create. Now, this is exactly the time when having a trusted banker is worth its weight in gold. So therefore, this brings us to the segment 8, the 3 things that will tell us where this goes. Now, as an investor, you should be watching the Sensex every 5 minutes. You should not be checking your portfolio app obsessively. This is not useful information. What you should be watching, what I am watching, are the 3 specific indicators that tell us whether the crisis is resolving or deepening. Point 1, the tankers crossing through the Strait of Hormuz. Every intelligence firm like Kepler, Raystead, and the Vortexa track tanker traffic in near real-time basis. If crossings begin to improve even marginally, it signals the beginning of the supply normalization. Now, this is the single most important data point in the world right now. G7 and IEA strategic petroleum reserve announcements. Yes, a coordinated release of SPR oil by the G7 nations and the International Energy Agency can take $10 to $15 off the crude price very quickly. Now, this would be a significant positive signals for the market. Watch for any joint communication from the G7 finance minister's call. The third thing that you should be watching is US diplomatic signaling. This conflict has a political dimension that is directly tied to the American domestic politics, elections, inflation, consumer sentiment. Now, if the Trump administration shows any willingness to engage in the de-escalation, the markets will respond sharply and positively. Watch official statements and Truth Social, frankly. Now, key takeaway 8. Stop watching the Sensex. Start watching the street. Your investment outcome over the next 12 months will be determined far more by what happens in a 40-kilometer wide waterway in the Gulf than what the Sensex does tomorrow morning. The focus on the variable that matters, not on the one that is the loudest. I want to close by saying something personal. When I started Finogent, the vision was not to be a distributor of the financial products. It was to be a genuine partner to you in your wealth journey. A partner who calls you in moments like this and not to sell you something, but to think with you. Many times I tell to my clients, I'm not working for you, I'm working with you. So we are here with you in your journey to prosperity, to stand between you and your worst instincts. It is more of a behavioral management than financial management, to be the calm in the storm. Today was at 10 out of 10 on a difficulty scale, if I may say. The markets fell sharply. The rupee hit the all-time low. A war in Middle East is disrupting the global energy supply in the ways not seen in decades. And somewhere in the world, somewhere making a decision right now to panic sell their investment portfolio and move everywhere to the savings account. I want you to make a different decisions today. I want you to take a breath, to remember why you invested in the very first place, for your child education, for your retirement, for the home you want to build, the financial freedom that you always aspired to have. None of those goals have changed today. Not one of those goals. So the market will recover. They always do, not because I am an optimist. I am actually quite a pragmatist, but because the alternative is a permanent destruction of human enterprise and an economic activity. And human beings as a civilization have shown an extraordinary resilience and capacity to rebuild, to adapt, to grow every single time. Now, India's story is not over. It has barely begun. We are in a country of extraordinary demographic potential, of the rising incomes, of the government that is building infrastructure at a pace we have not seen before. An external oil shock, however severe, is a chapter in that story, not an ending to that story. So here is my ask of you tonight. Do not act out of fear. Call your advisor or a banker. Call us before you make any significant portfolio decision. Let us review the situation together and calmly with an information rather than emotion. This is what we are here for. If you have a specific question, please write to us, or you can directly DM me. You have my credentials. Now, I am Rajat Dhar, and this has been the Managing Partners Desk from Finogent Solutions LLP. Stay steady, stay invested in quality, and stay in touch. Good evening.